Most investors lose money not because they pick the wrong stocks, but because they have no plan when markets turn against them. If you have ever searched for how to build long-term wealth or best investment strategy for beginners, you have landed in exactly the right place. That is exactly why we built the 120-month blueprint. This is a decade-long investment framework designed to help you build, grow, and protect your portfolio through 3 critical milestones: Year 1, Year 5, and Year 10. Each milestone represents a distinct phase of your financial journey, and together they form a complete system for serious, long-term wealth building that works whether you are just starting out or looking to accelerate what you have already built. Over the next several minutes, we are going to walk through every phase in detail. Stay with us, because this blueprint could genuinely change your financial future. So why 10 years? Why not 5 or 20 or somewhere in between? The answer comes down to 3 powerful forces: compounding, market cycles, and behavioral discipline. 10 years gives your money enough time to compound meaningfully. Even modest returns snowball into significant wealth when left untouched long enough. It also spans at least 1 full market cycle, meaning you will likely experience both a downturn and a recovery, which is essential for building real investor confidence. But perhaps most importantly, a 10-year phased framework removes emotional decision-making from the equation. When you have a structured plan telling you exactly what to focus on at each stage, you stop reacting to headlines and start executing with purpose. This blueprint is not about overnight riches. It is about building something resilient, strategic, and genuinely life-changing over 120 months of intentional action. Now that you understand why 10 years is the ideal time frame, let's map out the 3 distinct phases you'll be navigating throughout this blueprint. Year 1 is your foundation phase. This is where everything begins, where you build the financial bedrock that every future decision will rest upon. Get this wrong, and the entire decade suffers. Year 5 marks the growth and optimization phase. By this point, you have momentum, and the goal becomes maximizing that momentum intelligently through diversification, tax strategy, and increased contributions. Year 10 is the wealth protection and legacy phase. Here, the mindset shifts from building to preserving and generating sustainable income. Each phase builds directly on the previous one. Skip a phase or rush through it, and you compromise the entire journey. So stay with us, because what comes next is where the real transformation begins. Now let's get into the heart of Year 1, and it all starts with one non-negotiable priority: getting your financial house in order before you invest a single dollar. The first step is building an emergency fund covering 3 to 6 months of living expenses. This is your financial shock absorber. Without it, one unexpected bill forces you to liquidate investments at the worst possible time. Next, eliminate high-interest debt, especially credit cards. Paying off 20% interest debt is essentially a guaranteed 20% return. No stock can reliably beat that. Finally, set a clear monthly investment budget. Know exactly how much you can commit every single month without fail. Think of this phase as laying your foundation. Because here is the truth: even the most brilliant portfolio strategy completely collapses without a solid financial base underneath it. With your financial base in place, the next step is choosing where your money actually lives and grows. The right account makes a significant difference. A Roth IRA lets your investments grow completely tax-free, making it ideal if you expect higher income later. A 401k, especially with employer matching, is essentially free money you should never leave on the table. Taxable brokerage accounts offer flexibility when you have maxed out tax-advantaged options. Once your accounts are set, keep your allocations simple. A 3-fund portfolio works beautifully for beginners. United States stocks for domestic growth, international stocks for global exposure, and bonds for stability. With a 10-year horizon ahead, you can afford to lean heavily into stocks, perhaps 80% stocks and 20% bonds, giving your portfolio room to grow aggressively while maintaining balance. Now that your accounts are set up and your allocation is in place, the real work begins, and that work is showing up every single month without fail. Automating your contributions is the single most powerful habit you can build in year one. When investing happens automatically, you remove emotion from the equation entirely. This is where dollar-cost averaging becomes your best friend. By investing a fixed amount every month, whether the market is up, down or sideways, you naturally buy more shares when prices are low and fewer when prices are high. Over time, this smooths out your average cost and reduces the stress of trying to time the market perfectly. Nobody can do that consistently, not even the pros. So set your contributions on autopilot and let the system work. Now, challenge yourself to set a year one savings target that excites and slightly scares you. Now that you have spent 4 years building your foundation and staying consistent, it is time for one of the most important moments in your entire investment journey, the Year 5 check-in. This is not just a casual glance at your account balance. A proper Year 5 assessment means comparing your total portfolio value against the projections you set at the beginning. Did you hit your targets? Are you ahead or behind? Next, examine your asset allocation. 4 to 5 years of market movement almost certainly caused drift away from your original targets. Rebalancing now matters more than ever. Also ask yourself honestly whether your risk tolerance has shifted. Life changes, and your portfolio should reflect that. Year 5 is a genuine inflection point where disciplined investors accelerate their wealth while others stall from complacency. Now that you have assessed where you stand, it is time to level up. Year 5 is when your portfolio graduates from basic to strategic. This means introducing new asset classes that can enhance returns and reduce overall risk through true diversification. Real estate investment trusts, commonly known as REITs, give you exposure to property markets without buying physical real estate. Dividend stocks provide a growing income stream that compounds beautifully over time. Sector-specific exchange-traded funds allow you to target high-growth industries with precision. But diversification alone is not enough. You also need to rebalance consistently. When one asset class outperforms, it throws your target allocation off balance. Trim those winners systematically, not emotionally. Rebalancing is not about abandoning success. It is about maintaining discipline and protecting the structure you have carefully built. By year 5, your earning power has likely grown significantly, and this is where the blueprint demands you get aggressive. The biggest trap investors fall into at this stage is lifestyle inflation, spending more simply because they earn more. Instead, commit to redirecting every raise, bonus or promotion directly into your portfolio before it ever touches your lifestyle. Think of income increases as portfolio fuel, not lifestyle upgrades. Beyond your primary job, year 5 is the ideal time to explore side income streams. Whether that is freelancing, consulting, selling digital products, or rental income, every additional dollar earned outside your salary becomes an opportunity to accelerate your investment timeline. Even an extra $200 to $500 monthly compounding over 5 more years can add tens of thousands to your total portfolio value. Increase your contribution rate by at least 1% every 6 months without exception. By year 5, your portfolio has grown enough that taxes can either quietly drain your returns or be strategically managed to supercharge them. This is where intermediate tax strategies become essential tools, not optional extras. Tax loss harvesting allows you to sell underperforming assets to offset capital gains, reducing your taxable income meaningfully. Meanwhile, maximizing contributions to tax-advantaged accounts like your 401k and Roth IRA shields more of your money from the government each year. Understanding capital gains brackets is equally critical. Holding assets longer than 12 months qualifies you for long-term rates, which are significantly lower than short-term rates. When applied consistently over the remaining 5 years, these strategies can add tens of thousands of dollars to your portfolio, not through better picks, but through smarter planning. Now that you have spent 5 years building and optimizing, something important needs to shift in how you think about your portfolio. Approaching year 10 is not just a numerical milestone, it is a fundamental change in purpose. You are no longer solely focused on accumulation. The conversation now moves toward capital preservation and income generation. This is where strategy meets intention. Ask yourself what you actually want this portfolio to do for you. Do you want to retire early, achieve complete financial independence, build generational wealth your children and grandchildren will benefit from? These are not abstract questions anymore. They are the lens through which every future decision gets made. The blueprint does not end here. It evolves, and so must your mindset as you enter this final and most powerful stretch. Now that you have spent nearly a decade building your portfolio, it is time to pressure test everything you have created. Stress testing means asking hard questions like what happens to my portfolio if a recession hits tomorrow, if inflation spikes to double digits, or if we enter a prolonged bear market lasting several years. Run these scenarios using portfolio analysis tools or work with a financial advisor to see where your vulnerabilities lie. Once you identify the weak points, begin gradually shifting your asset allocation toward a more conservative mix. This means increasing your bond exposure to provide stability and cushion against equity volatility. You should also start adding inflation-protected assets, like Treasury inflation-protected securities, commonly known as TIPS, along with commodities like gold. These assets act as a financial shield, preserving the wealth you have worked an entire decade to build. With your portfolio stress-tested and protected, the next critical step is building a smart withdrawal strategy. This is where the bucket approach becomes invaluable. You divide your assets into 3 buckets. The short-term bucket holds 1 to 2 years of living expenses in cash or stable assets. The mid-term bucket covers years 3 through 7 using bonds and dividend stocks. The long-term bucket remains invested in equities for continued growth beyond year 7. This structure ensures you never sell stocks during a downturn just to cover expenses. Now, regarding safe withdrawal rates, the widely referenced 4% rule suggests withdrawing 4% annually from your portfolio. However, a more conservative 3 to 3.5% rate offers greater longevity protection, ensuring your principal sustains you for decades without premature depletion. Reaching year 10 is a monumental achievement, but your work is not finished. Now it is time to protect everything you have built and ensure it outlasts you. Estate planning is no longer optional at this stage. Start by reviewing all beneficiary designations on your retirement accounts and life insurance policies, because these override anything written in a will. Speaking of wills, if you do not have one, create it immediately. Consider establishing a trust to control exactly how and when your assets transfer to heirs while avoiding the costly probate process. Life insurance can also serve as a powerful wealth transfer tool, especially for larger estates. Remember, growing your portfolio matters, but protecting it legally and structurally matters just as much. A legacy is not built by accident. It is built by intention, preparation, and deliberate planning. Here is the bottom line, and I am going to be brutally honest with you. Retirement is coming whether you are ready for it or not. The difference between sipping coffee on a beach and counting pennies at the grocery store comes down to the decisions you make right now, today, in this moment. If the idea of surviving on cat food and regret in your golden years does not sit well with you, then do something about it. Hit that subscribe button right now, because every week we are dropping the exact strategies, tools, and blueprints that turn ordinary people into financially free ones. Ring that notification bell so you never miss an episode, because one missed video could be the one that changes everything for you. Share this with someone you care about, because nobody should have to figure this out alone. Your 120-month journey starts with a single click, and that click costs you absolutely nothing. Your retirement, however, will cost you everything if you wait. So subscribe, stay committed, and let us build that future together, one smart decision at a time.